He lost everything. How did this happen? Seagram started as whiskey. It grew into a global brand. It became a diversified conglomerate. By the late 20th century, it owned major music and entertainment assets. That change set the stage. The company stopped being just a liquor maker. It entered media. It entered tech. New risks followed. The family name mattered. The Bronfmans had run the firm for generations. Pride and pressure lived in the same house. Heirs learned two things: how to sell a bottle and how to sell a deal. The company's identity changed. So did the family's life. Then leadership made a bet. They chose a pivot. They traded core assets. They placed roughly $34 billion of value on paper. They swapped the world's largest music company for a tech stake that was already shaky. The deal was bold. It was public. It was glamorous. Boards signed. Cameras rolled. The balance sheet changed overnight. Goodwill swelled. Debt grew. Control levers moved away from the family. Partners and markets now held the keys. Executives toasted. Red carpets replaced distillery tours. Long-serving staff watched the tapes and felt unease. Markets loved the headline at first. Stock jumped. Press called it visionary. The label landed big signings. Hollywood shook hands. Momentum built. Risk felt smaller in the glow of success. Managers who had once been cautious were praised for daring. Dissenters grew quiet. New risk. Valuation optimism. New decision. Leverage to buy prestige. New consequence. Few voices left to say no. Cash flows told a different story. The liquor business still made steady money. The new assets did not. Integration stalled. Tech partners missed targets. Distribution shifted online faster than expected. Debt payments came due. Pressure rose. New risk. Timing mismatch. New decision. Push harder on growth. New consequence. Covenants tightened. Analysts began to write close notes. Creditors asked questions. Banking partners repriced lines. The market introduced a new price for the company's dreams. Hiring slowed. Projects froze. Mid-level managers took cuts. Creatives felt funds vanish in real time. Then a shock landed. The tech bet failed to integrate. A market downturn hit the sector. Financing terms evaporated. Valuations collapsed. Contracts tied to the $34 billion transaction triggered clawbacks and contingencies. Stock slid. Ratings fell. Liquidity evaporated. New risk. Covenant breach. New decision. Sell assets under stress. New consequence. Control slips. Votes mattered now. Debt holders and partners had clauses that converted to votes. A single vote swung control. The family no longer held the majority. Deal terms allowed outside actors to claim board seats and sell assets to cover losses. What had been a paper value turned into a courtroom issue. The merger unraveled. What was once a single, proud entity split into pieces. The 100-year liquor dynasty, in corporate terms, ceased to exist. Catalogs and studios were sold. Brands moved to new owners. The public saw headlines. Assets transferred, contracts broken, pensions at risk. New risk. Reputational contagion. New decision. Litigate or settle. New consequence. Legal fees and delays that drain reserves. Human cost was immediate. The Bronfman family watched control walk away. Generational wealth shrank in monthly statements. Long-time employees lost jobs. Retirees saw pensions threatened. Label artists lost institutional support. Studios lost budgets. Towns that relied on jobs felt payrolls thin. New risk. Community collapse. New decision. Stop local investments. New consequence. Shuttered stores. Empty offices. At the midpoint of this film, view the ledger yourself. Visit the documentary site to see the entries that changed hands. Outside, actors benefited. Opportunists bought catalogs at fire sale prices. Competitors moved in. A concentrated music world became even more concentrated under new owners. Market leadership shifted. Regulators opened files. Courts filled with litigation. The family's name stayed in papers, but not on the balance sheet. New risk, consolidation, new decision. Buyers bundle assets. New consequence. Fewer independent labels survive. Forensic economists later picked apart the path to ruin. They traced bad valuations. They enumerated governance failures. They logged every leverage point that amplified loss. They marked the exact board votes that mattered. They counted the missed hearings, the ignored memos, the dissenting emails never escalated. New risk, ignored warnings. New decision, silence dissent. New consequence, no corrective action. The accounting did not lie. Goodwill impairments arrived as cold numbers. Debt covenants demanded sales. What had been ambition became a forced auction. The company's lines on a page turned into brick-and-mortar consequences. Money left the organization in documented tranches. New risk, forced divestiture, new decision, accept low bids to meet deadlines, new consequence, irreversible value destruction. Families rebuilt differently after the fall. Some members pursued philanthropy. Some retreated into private life. Some tried to buy back pieces with new partners. The social fabric of the family changed. The dynasty's name endured in foundations and charities, but not in corporate control. Artists wrote new songs about instability. Ex-employees started small firms. Local economies searched for new anchors. Lives rearranged around smaller paychecks. A century of identity shifted into a different rhythm. In the final accounting, several threads stand out. First, mispriced assets. The $34 billion figure was real on paper, but fragile in courts and markets. Second, governance failures. Concentrated decision-making without checks allowed one big bet to reshape a whole company. Third, timing and market structure. The dot-com crash made speculative valuations impossible to sustain. New risk, single-point failure. New decision, place a decisive bet. New consequence, systemic collapse. The documentary reconstructs the ledger entries. It shows the board votes. It reads the emails. It maps the decisions, step by step. It shows which choices could have stopped the fall. Staggered divestitures, tighter covenant controls, independent value assessments, and more weight to dissenting directors. New risk, repeat of the same mistake. New decision, learn and reform. New consequence, safer firms. The living costs of the collapse are visible. Jobs lost. Homes changed hands. A family redefined its legacy. An industry reshaped ownership of culture. The real ledger is not only dollars, it is the days people lost, the careers cut short, the creators left without steady backing. Final lesson, ambition cannot replace discipline. Big paper values require real cash discipline. Boards must be able to say no. Dynasties must build fail-safes for the worst outcomes. See the full forensic breakdown at our site. Review the votes. Read the ledger. Learn the costs. He lost everything. Now we know how.